What's up, everybody? I put this little thing together. We've been talking about trading plan and things like that, and it's kind of like a treasure map. And I'm kind of vague on purpose because this is not something that you can just copy from somebody else. There's a lot of self-discovery that goes into it, and how you feel about you is really important, and where you're calm at, where you have conviction, where you can hang out and just let trades work for you. And I learned a lot about myself even last week. It's an ongoing thing, but this is my current rough draft. I just typed this up yesterday. I've got a handwritten one somewhere else that's more detailed, but I wanted to go from scratch and work on this. I figured this would be better than just doing a little bit at the end of each video. I'll just blast this out here. This is my trading plan. I notice at the top it does not say your trading plan because it's mine. And you do things differently than me, but I think there's some things that are absolutes if you trade like me with a swing strategy that's based in value and cash flow. Um, and I think if you think that you can change some of the things and you don't get the same results, you maybe don't understand why I do the things that I do. So uh, rewatch the playlist, put more repetition in. I'm very consistent about what it is that I do, and that's what gets me consistent results. So, starting off, this is for the trading account. All right, I got 3 different accounts that serve different purposes. I have the trading account, which I do on the blog. That's mainly what this is pertaining to. I also do a public one on the YouTube, right? So, but that's the trading account. The other account would be investing account. So the trading account profits feed the investing account, right? And then um, the investing account goes half and half. Half of that goes into my checking account, and I just spend it on whatever, living expenses, whatever I want. And the other half goes into what I call an emergency fund. Now, a lot of people that are richer and smarter than me would probably say, hey, that's not an emergency fund, but I don't give a shit. Um, it's my version of an emergency fund. That's where I buy things like master limited partnerships, collateralized loan obligations, income. I'm just buying straight income there. All right. And then half of that income feeds into the trading account. So you can see it's like a circle where the money is constantly moving. And that's probably not the most efficient way to do it. You can probably find a better way to do it. You may be better off just buying and holding and walking away, but I really don't think so. That's not what my results have told me. And just remember, all this is based in data. You know, from the past 6-7 years, I've been trading and tracking data since day one. So um, have some data to back it up. Just don't be emotional opinion, right? Those kind of people get destroyed in the markets. So I just want to, if any of those people are listening, I just want to say thank you for the money. But it's based in data, and it's not based on any kind of emotions or opinions, even though those have played into how I set up my trading plan, because I know me now. I don't even think I really even knew myself that well before I started trading, but I know myself very well now. So it's been a fun journey. General rules. These are things that just didn't really fit in anywhere else, and it's at the top because it's the most important. It's kind of the credo, right? It's words to live by, right? So number 1, never sell for a loss, with the exception of tax loss harvesting. Now I have a situation now. I am in Verizon and Intel, which I have been for a while. So if you look at those charts, man, they've really been stinking it up. So I have an opportunity there for the tax loss harvest, but I have so much write-offs already carry over that because we had COVID, right? And I did a lot of harvesting there, so I've got plenty of write-offs. But those are 2 that are on my radar, and should things start turning up, I'm not sure, but I kind of think they will. I'll be ready to do those. Now, the way that works is you don't really lose, okay? If you do tax loss harvesting right, you don't lose nothing, okay? You just get the tax loss. So, if you don't understand how that works, then don't do it until you understand more. Go research. Number two, I don't buy assets that do not cash flow. So, right now, I've been kind of going back and forth. I went and looked at a potential investment property, is the way the bank would call it. But it doesn't have any tenants. I don't look to be renting it out. I'm just looking for the spread between where the value of it is and where the price was, and I was going to trade the difference, right, and pay for the house that way. But it doesn't currently cash flow, so that is a rub for me. You will not see me buy any stocks that don't cash flow. It's that important to me. So now, if a stock paid a dividend and I bought it to trade and it stops paying the dividend, I'm still going to trade through. Or number one, I'll be looking to just lower my cost basis and hang on, right? So I'm still going to have the stock, is what I'm trying to get at. I'm not just going to sell the stock for a loss. That's never an option. That's not okay with me. We do not lose. There's something about a winning mindset too. You know, it's our job to provide for folks. You know, we're capable. You wouldn't be watching this video if you weren't capable. You're capable of doing a little bit of research and making it happen. So, live up to your potential. Swing trading. This is it. So, this is where I have the most data. It goes consistently pulling money out of the market every single month forever, ever since I've done it. Now, the ups and downs of my account have come from trying new things, right? And at first I thought, man, that was so stupid. You got something that works. Why try anything else? But there's a little bit of self-discovery that goes into that, and I think it's just normal human nature. So I tried some stuff, done some dumb stuff too. But this is what fits good with my psyche. So I'm okay holding a stock that goes through the toilet like Intel. Pulled the chart up. I'm cool. I'm not nervous at all. But I get the couple $100 dividend every quarter. I'm good with that. And I use that to buy other companies, which is fine. Something about holding the cash flow, whereas if the price of a stock that pays a dividend goes down, your yield goes up. Okay, so in a really weird way, when the stocks go down, it's a positive. Okay, but if stock doesn't pay a dividend, you may be getting a better deal on a growth stock or something like that, but you're not going to see dollars that tell you, hey, this was positive. In a dividend scenario, especially if you have cash to buy more when it goes down, you see it in dollars monthly that come in. So this fits good with me. We talk about the ranges as I go through the videos every day, and we're looking at the screener, but this is kind of a basis. I've got a top 10 list, but on the list there are some utility stocks like Duke Energy, commodity stocks like Altria, and those I still want to keep at a lower PE, that fit in down here. But Apple, Microsoft, Pepsi, Coke, Johnson & Johnson, McDonald's, they're rarely ever going to trade below a 22. You'll see them, but if you're waiting for a 15, you're probably just never going to get to buy. So I've increased that because there is a huge importance on quality. All businesses are not created equal. They do not have the same profitability or business moats, and they do not have the same outlook over time. So I'm okay to pay up for quality, but there's only a handful of companies, 6 of them. This is it. Banks, I try to stick to JP Morgan and Chase, but I will flip on a swing trade anyone that comes along. We are currently in the bank crash, and if you're wondering, yeah, I bought a bunch of them because when value comes across my desk, it's like putting peanut butter on a mousetrap. I want some. And if I got cash, I'm going to get some. We'll get to that later on down. My universe of stocks. So these are 46 companies so far, something like that. Roughly 50 companies. And they have been picked out, and I've looked through the dividend history, the earnings history, done basic research, nothing too in depth. I think there's little value in that, but that's just not my approach. But I'm okay to pay up for those. So 15 has been the kind of the understood average over the course of 100 years for stocks for PE. But with my universe, I'm okay to pay up, right? I'm all right to pay a little extra. So that's why this is in here. And I do take the forward PE and the PE and average them out. So what that does is that accounts a little bit for growth, and it takes a little bit of the accounting snafu out, because for 1 year to another year, a company might do a mass write-off or a one-time charge or something like that on the balance sheet that makes it look a little wonky. So I got a 2-year spread instead of a 1-year spread. Like I said, everything else is about 15s. REITs don't apply. The REITs are all based on cash flow of rents on the property, and they just pay those out as cash. Typically, I just use the cash as how I value it, because that's essentially going to be your return. Earnings. All right, the stock market only cares about future, not the past. Earnings per share projected got to be good for next year and the next 5. I'm really stickler on this, especially if it's a company I don't know that much about. It just happened to pop up on the screener. I'm probably a little more lenient if it's in my universe. If it's in my universe, you're in the gang. Blood in, blood out, right? These are my stocks. And I know over super long periods of time, they really perform well. So if a company that's in my universe is having a bad couple years, like Intel, I don't care. You're still on the team. No more to say. Volume's easy. I use 500,000 or more. If you look online, the people that I watched when I was researching, they would say 1 million shares or more. But I think 500,000 is enough. And a lot of the companies that I have that are 500,000 to 1 million in my universe that don't quite make 1 million, they're like $200 or $300 a share. So in the grand scheme of things, I can still move the same dollar amounts or similar for me. Now, as my account gets bigger, maybe I ditch that. I don't know. This is a working document, but these are the rules. When Monday's market fires up, none of this stuff can be changed. I think about it on the weekends, and that's what I encourage you to do too. When the market's in free flow, your emotions are involved, even if you don't understand it. They are. You got to have some time away to think. Okay. RSI. It's not your golden path to money or nothing like that, but it does give you an idea. Hey, this has been selling off for a while, right? The real key to using an RSI strategy like this, a lot of people use something similar or a MACD or something like that, but the real power of it is if you have money. The secret to making money is having money. It truly is. Or access to money. Access to money is just as good as having the money. So just understand when you buy something and it's 30 RSI and it goes down, it doesn't mean the system doesn't work. It means the stock is still going down. And most of the time, when I take a position, the stock continues to go down. And that's why I like to trade this way, because it allows me to build a position. All right. And you'll see down here when we're talking about how much of my account I used for each purchase and stuff like that, you'll understand that if you just only did the first purchase amount, you wouldn't make that much money. But I end up doing pretty good because I'm able to average in, and then I just dump out. So it works for me. Dividend yield, these are just the settings for the screener, right? So over 1%, because tech companies don't pay a lot. Really was set for Apple, because I want to make sure Apple hit the screener. USA, I don't like to pay foreign tax. It's not, a lot of times you can write it back off, but why? There's plenty of US stocks. I do have some Canadian banks and commodities, because I do like to have a little bit of a spread away from the US dollar, but the US dollar is still the king on the street. So There's really no worry there. And most of the big companies are global anyway. Debt. There's no good way for the screener, right? But remember, a bank or a financial stock should have little to no debt because they're spreading money on money, right? The REITs can have higher debt. That's all right. Just think about it this way: when you got a mortgage, a lot of you did a FHA or some crazy stuff where you had 3% down or some crazy 5% or whatever. So you were in debt 95%. So when professionals do real estate, they only do stuff that cash flows, and it's likely they'll be higher on the debt stream, right? Plus, it's a trust, so that works a little differently too. It's limits them in the way they can raise capital. So REITs, they just don't count. But I like REITs because that's the only way currently, besides my current home, I get exposure to real estate. And it's not the same as owning a real house. I get that, but I like REITs because they move counter-cyclical to the market sometimes, not all the time. Like when stuff's bad, everything goes down, and stuff's good, most of the time everything goes up. But there are times in the wiggle where REITs provide opportunity, and they have huge cash flows, so I like them. When to buy? Market down. The market must be down. Market down? Buy. Market up? Hope something sells. But basically, take the day off. Now, I set alerts on my phone that will just light up. If the market's just way up, I'll set the alert, go along on my day, and if it lights up, I've already got a prepared mind from the morning, so I know what I'm buying, and I execute very quickly. Because sometimes if you get a market situation where the market gaps up and retests, it's only going to dip just for a second. So it's easy to miss. But if you're prepared, always be prepared, you can make some money. Sell, there we go. 1%, right? That's what I do. Why 1%? When I first started, back in the good old days, it was 5%. Then it went to 2%. Why did I settle on 1%? First of all, did any of y'all do the homework from the last video? Where you have 1% compounded 200 times? If you haven't, this is a good time to do that. Basically, it fits my personality. I'm okay taking small progress and watching that compound more rapidly. Is it the most efficient way to make money? Probably not, but I don't care. It's the way that is the most fun for me. I enjoy this kind of stuff, and it fits me, so that's where I settled at. Could yours be different? Yeah. But when the market starts sliding and you're holding on a bunch of stuff, don't come crying to me. Because even in a down market at 1%, I can get in and out, in and out, in and out. And if you look at the blog, I'm selling stocks every single day. And I'm buying stocks every single day. And when you move money like that, the way the math works from averaging down and whatnot, it's hard to beat. It's hard to beat. How much to buy? Okay, here's the juicy part. This is the way I run my stuff, okay? This is not for you. You got to try your own stuff out. But basically what this is meant to is I've turned up the aggression meter just a hair. And I like to do this route because when the market is slow, I like to be able to put more money in because all the positions work. They all make money over time. Never had a loser on the swings. So even through COVID and all that, now it might have took 2 months or some crazy stuff, but they all win. Market all goes up eventually over time. And like I said, as stocks go down, you buy more yield. So that helps you average down even faster once the dividends get paid. But for me, if I'm at a cash account 50% or more, I go with 4%. Now less than 50%, I go with 2%. And I do that until I'm no longer in cash. Once I start dipping into margin, I use 1% up to 25%, just one a day. And then when I get between 25 and 50, I do 0.5%. Now, margin may not be the thing for you, and if you don't have months and years of profitability established, don't use margin. That's stupid. But if you have an edge, I don't see nothing wrong with it. Plus, most of my money is going to be filtered into investing anyways, so I can cover the margin with other assets. No big deal. But I like it because it slows me down, but keeps me buying every day. It's unlikely that you're going to have 3 months where I get the money all in at a 30 RSI when it's already down, and the market keeps going down for 3 months with zero pullback. Remember, I'm selling at a 1% target. I don't need a big pullback. If you go through the dot-coms, the 08s, and all that stuff, besides flash crashes and stuff like that, but even those, go back to look at those. It went down crazy in one day, and the market's like, oh, damn. And if you measure from that moment, 3 months out, tell me you wouldn't make 1% if you was buying every day. I went through every scenario, and this is what I found works for me. So that's what I do. Now, obviously, in the public account, we just don't have that much money, so this doesn't play in as much yet, but it will. And we won't use margin in that account. So, spoiler alert. All right, order of operations. So these are sections that probably need some more work by me, but I put them in here. Basically, when you have a big pocket of money, what do you buy first? Right? If you got several options, which one do you buy first? You got to have an order of operations. This is a snowball. I stole this from Dave Ramsey. Okay? He did it with debt. He has the debt snowball, right? And I was listening to him and I thought, wouldn't it be cool to incorporate that into a stock strategy? And it works. It does work. You just list them down from smallest to biggest. And when you're buying, you're going to buy the smallest one first because that moves the average cost basis more on a smaller position than it would on a bigger position. It allows the math to work harder. Now, once you get to where you're into margin, then you can only buy one, right? So it's really important. That's where I'm at currently. It's really important to buy the right one, right? If you only got one hit, you want to make it count the most. So smallest to largest. Then work down the list. Still got to be under 30 RSI. We ran into this. If you're watching the videos a day or two ago, we had J&J. It's still in a perfect buy zone for anybody that's a swing trader, understands charts or whatever. But that's not how I do it. If it's not on the plan, I don't do it. It's where your discipline will come into it. You know, do what you say and say what you do, right? But it was just above a 30 RSI, so I couldn't have it. So it's all right. I've been told I couldn't have it most of my life. I've been poor, so no big deal. Gaps. This is something that most of you don't get too much exposure to because I don't share it on the public site, but it's part of my trading account. You will see it on the blog. Usually I'll title the blog post either gap, swing, or average down. Now, you can scan them only in cash, and the gap has to be more than 1%, and I sell the 1%, right? So I'm buying the gap down, and I'm selling it before the gap fills, right? Once position falls to below 30 RSI. It's all right. Yeah, I just did this yesterday. So occasionally a swing or a gap will go totally against you, and it becomes a swing. These are all pre-scanned companies. These are all in my universe, okay? So it's really important for that because I can take action quickly, without doing a lot of research on the company. I've already done the research. It's a solid company. I don't care what the news is. It's going to be, oh, crap, another lawsuit, or oh, this or that. I don't care. And just remember, these are only very small positions, right? Max is 4%, right? That still leaves 96% in good stuff, so it's okay. But what this allows me to do is take advantage of news, because sometimes people will freak out, or there's something that happens in a foreign country. And something I learned from Forex is the different times that the different markets close. And you can see it in the stock market if you look at the charts every day. So sometimes some stuff happens with the foreign currency or the US dollar, and price is different. Your assets get repriced overnight. So I've noticed this works for me. It's a 100% winner so far. I've got hundreds of trades so far. The average annual return on the gap strategy is 131% per year. They don't happen all the time every day, but when they do happen, it's free money. I take it. I'm happy with it. So as that has worked out, I have got into triple levered ETFs. Now, I learned a little something last week. I went short twice last week. I did good. But one thing I learned about myself was I'm not as comfortable going short, especially because basically any way you can think of to short the market, there's a built-in cost to it. So time becomes your enemy. Whereas if you go long and you just own stock, or you want to sell covered calls or whatever, time is your friend because you're getting paid by dividends and other things, right? But going short, usually there's a cost involved, and it just makes me nervous. I don't know why. I understand charts. I know how to read charts. I take the correct setups. I do the right execution, but there's something about it where I don't feel comfortable holding it until the sell target. And the whole saying you can't never go broke taking the profit, that's total bull. If you're taking small profits all the time and big losses, you'll never make money playing stocks. So if you're doing that, just stop. Just stop altogether. Paper trade. Take half the money's left in your account, send it to me. Take the other half, go have fun, because you're going to lose all of it. Every penny. The math doesn't work out that way. So the fact that we never sell for a loss takes that out of the equation, right? So that's why I've set up what I've set up. Now, the triple levered ETF, here's a little bit of background. So for the S&P 500, since its existence, every gap down has always filled, because over time, now it can be long periods of time, but over time, the market always makes new highs. Okay, and if you don't fundamentally believe that, I'm not sure why you're still watching, because I do, and that's the credo, right? But this allows me to make outside sized gains only. Here's the never short part. Even though I made money twice last week short. No. Cash. So what this allows me to do is to make, instead of 1%, basically make 3%. They're triple levered. But only when I'm in cash. So what that means is the market is probably doing well. Currently, I still have about a 2-column sheet full of positions. I have tons of positions. The market's been sliding, right? But as those start selling off, the snowball builds and I get back in cash. If an opportunity presents itself, of course I'll take it. These are no average down, only in cash. And the reason for that is there's what's called decay. So if you don't understand that, don't buy a triple levered ETF. Currently, I'm only doing 2. I'm doing the Qs and the SP 500. So that's where I'm at so far. Maybe I add more, but I really don't think I'll need it because I haven't had any problem getting money in the market. If I end up sitting for a long period of time in cash and I just feel like I'm losing gains or something like that, maybe I'll look into something like that down the road, but I don't think I'll ever need to. Because if you think about it, if the market gaps down 1%, I play five markets, okay? So you're going to have, if you are all in cash, my strategy says how much? I mean, cash over 50%, that's 4%. So 5 markets, that's times 4, that's 20. Plus 2 triple levered, that's 28. That's 28% right there on a gap down. Now you're going to tell me there's no more out of 50 stocks, there's none other stocks that are gapping down. Everything follows the market. If a day like that happens, I'll have my money in very quickly. Like a sniper. And I really hope this does help you. It's an odd one. I put it off this long on purpose. If you're new to what I do, go back to the playlist and watch all the videos. We've been doing this since August, late August. So I feel like now we're, 6 months in. Let's add a little more, right? And if you're not constantly learning in life in general, you're falling behind. So I'm giving a little bit of what I've learned. This is not for you to just follow and mimic or whatever, but as you start playing around, this has worked for me, and it continues to work for me, and I don't see it changing anytime soon. What I need, my basic outlook now is to do this for another year or two, and then make a change if something needs tweaked. But you have to do long periods of time. That's why it takes so long for me to learn stocks. When you go online, you see people, I learned how to be a profitable trader in 6 months or whatever. That's cool. That was not me. I didn't lose money because I always bought stuff that cash flowed. That's always been kind of cool to me. I had corporate bonds when I was in college. I mean, I like the fact of getting a monthly check. I like it. Now I get 500 checks. So I get checks every day almost. It's really, really fun and cool. But it took me a long time because I had to build the data, right? So that's how I did it. That's how I figured out stocks in a nutshell. If you got questions, reach out. I mean, I'm happy to help y'all. But ultimately, you have to make your own decisions. This is not a road somebody can just tell you, hey, do this. Because what happens is when the market turns, there's different cycles in the market. When the market turns, if you just blindly follow somebody, you'll hate them. Because you'll think the reason you lose all your money is because they're stupid. But you got to take ownership for your own decisions. And the biggest thing is increase your understanding. And like I keep talking about in the videos, keep your perspective in check, right? This is a long game, right? And hopefully you see as we go through the public account I started and things like that, that even when the market dips or goes sideways, we're constantly pulling cash out. And our cash flow will continue to grow month over month, year over year. So I hope you find this valuable. I did put a little bit of time into this. It helps me too. But I will do the investing account trading plan and an emergency fund account trading plan. If you guys want to see that, let me know. Post a comment, DM me, something like that. Let me know. Because if not, that's going to be for me. You can make your own damn plan. But this is what I got so far. It's kind of hard. It's kind of like a treasure map and speaking in riddles all the time. And people are like, well, why don't you just tell me? Well, because you can't. It's not possible. And it's kind of like when we talk about the market outlook and things like that. I'll have a bias and I'll be talking about one way and I'm like, well, but it could go down or it could go the other way, right? And you might think when you're new to stocks that the person talking just doesn't know what they're talking about. But the truth of it is the really good investor traders in the markets are prepared for either way, but they understand where the market should go. So people call it the 80-20 rule, but I call that over 50%. Because the market can do whatever it wants. But it does follow structures and patterns and things. It does. But those don't work 100% of the time. So if you bet all in on a pattern or strategy, the first time it doesn't work, you go bust, right? But if you buy companies that have made money for decades through recessions and through economic hard times and increase the dividend even in difficult times, you're going to have to convince me on how that doesn't pan out over long periods of time. Because so far for me, I'm 6-7 years in, it's been working really well. So I'm rambling at this point, but I wanted to go through this and actually share this. If you think there's value in it, let me know. and send me your trading plan. People are always so selfish. They want to ask me dumb questions, but send me your trading plan. Type it up and send it to me. If it's not written down, it doesn't exist. A life worth living is a life worth documenting, right? So get out there and do it. You guys can do this. I got full confidence. Keep it simple, especially if you're stupid. Isn't that what that means? But it don't have to be rocket science. It's 5 to 10 minutes a day after work. Follow the YouTube channel, and I'll do my part. Thinking about maybe doing a stream or something this week. I don't know. I just want to do a test stream. It's not to try to get a bunch of followers or anything crazy. But if you'd like to see the gap strategy in real time or a video, let me know. I might do that. Okay. I'm on vacation again this week. I'm preparing for retirement. I found out that I'm too scattered right now. I'm spread way too thin. And when you try to do everything, you're not good at anything, right? But I had to go down this road because if you want more, you got to do more, right? So I was at a position where I wanted more, and I started doing more, and I got more. So now we have new decisions to make. But I hope this weekend finds you well. Enjoy the tournaments tomorrow. I took the week off just to enjoy the tournaments, and we'll catch you later. Let me know if you need something. Peace.